Well, I think you mentioned a few words I want to pick up on. Before you said idiosyncratic, I want to pick up on that. And then, of course, systemically important. I think those are two key issues here, because what we're really talking about is the fear that's been placed in the markets since Silicon Valley Bank. Like you were just saying before, you were here just a few months ago, talking about Credit Suisse and its Tier 1 being above 14%. No one was worried about liquidity at that point. So what's changed since then? And really nothing has changed, except for Silicon Valley Bank has put us back in a frame of mind where all of a sudden we start thinking about how we didn't think that Washington Mutual Bank was anything more than idiosyncratic either. And it turned into a global financial crisis. So I think at this point, with rates having come up as steep and as fast as they have, we're all concerned that something in the system is going to break. And so we look at these vulnerable institutions and we wonder, is this going to be it? Credit Suisse specifically, again, like you point out, Tier 1 of over 14%, a liquidity coverage ratio of close to 150. I mean, I don't think that's the issue. And this is very clearly not Silicon Valley Bank. We have a very wide depositor base. We don't have a problem with asset liability matching. We also don't have an issue with rates hedges. So we're talking about two completely different things. On the other hand, you know, the Swiss National Bank couldn't afford to be sleepy watching that CDS blow out to 1,000. They had to step in and calm down the markets a little bit. So, you know, it's interesting. Banks have been an underperformer in terms of an asset class for what, close to a decade. And just recently, people have started to get enthusiastic on the banking sector again because of net interest margins and, wow, you know, rates coming up. This is going to be great for profitability. But there are a few, like Credit Suisse, that still have some outflow problems and reputational issues to deal with. So.
Yeah, I mean, to do the essay question, compare and contrast, 07, 08 was very much about the quality of the book that the banks had and whether they were financially viable going forward. This, over the last few days, seems to be much more about business models and whether business models are viable going forward. And obviously in the SVB case, the market decided that no. This bank no longer had a tenable business model with a positive price of capital. Now we're talking about Credit Suisse, and as you point out, the SNB has effectively told depositors, you're going to be fine. We backstop this bank, no problem there. So the focus then is on the business model. Does this bank enjoy perhaps the opportunity to rebuild itself over the next 12 months, or are we looking at a corporate event that sees part of the organization hived off to other buyers?
Well, that's all speculation, and I'm sure that a banking analyst can go into much more detail. I think I would say that Credit Suisse specifically is still one of the world's largest asset managers. It has $500 billion in assets, and certainly this could be a great turnaround story if the execution is good.
You've got to have some fairly patient customers of Credit Suisse to watch this one through, though, given the outflow that we've seen from the organization.
Absolutely. But I think, again, the stress that we're seeing at the moment really should have been predictable, because when rates come up so fast, certain business models get challenged. And I don't think it's a wealth management business model that gets challenged. I think much more, and why we saw it at Silicon Valley Bank, is private markets are going to be challenged. Because if I have the same prospect of return on investment grade credit, on cash, and on my implied equity yield, why would I take risk? I'm going to invest my money into money market funds or perhaps even into cash. And that's what we've seen happening by global allocators. And that then is a problem, because in private markets, they're calling capital. They can't necessarily bring their businesses to market, and they no longer have new investors. So all of a sudden, it causes some stress in the system, and business models that were built up on free capital no longer function. And so when you look at, for example, the spreads that you have on U.S. high yields, 500 basis points they closed last night in a stressful market situation. That's still nothing. I think the market is still way too sanguine and way too easy about this idea of a soft landing, very short, very shallow recession. I think we're going to see some pain before we work way through this. And I think that a recession is unavoidable. There's no way that we can hike rates like this, have a tightening of financial conditions, conditions, a sucking of liquidity out the market without some casualties.